Are you a dividend investor or see a dividend investment strategy as something you'll use to supplement your retirement income? If so, it can be a great strategy, but you need to be aware of and overcome 2 dividend investment fallacies. I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. I saw a post recently from someone that said, here's your retirement plan. Manage your income, manage your expenses really strictly. Really have it dialed in. Then save up as much as you possibly can into dividend-paying investments, dividend-paying stocks. Once you've saved up enough so that the dividends that those stocks are paying equal the amount that you are spending, again, because you're really focused on that, then you're able to retire. And I only wish it was that simple. That's close, okay? But if that's part of your strategy, if that's part of your goal, if that sounds appealing, it does to me, know that you still need to do a 5-factor retirement plan. It's not that simple, because oftentimes if you're just doing that, you're overlooking some expenses that you're not incurring right now, or maybe aren't factoring into that budget that you have, that you would need to factor in if you then worked this strategy and retired. One such expense is health insurance. Oftentimes when you're managing your budget, you're thinking take-home pay, right? And you're not factoring in health insurance that maybe is coming out of your paycheck. Another thing that you're typically not factoring in is taxes, because again, you're budgeting off of take-home pay and your taxes are being withheld from your paycheck. And so just know that you do need to still do a 5-factor retirement plan, but also that this dividend, that dividend approach and dividend investing as sort of your primary and sole retirement income strategy, it's gotten harder over the past several decades. It used to be that many companies, many publicly traded companies, that paying a dividend, paying a strong dividend, paying a growing dividend was a sort of badge of honor. It was sort of expected, and therefore generations ago, you could save up into blue chip stocks, if you will, have them pay a dividend, which was a competitive yield, 3% or so, and hopefully live on that, have that supplement your Social Security. Well, I would say starting with Warren Buffett and beyond, even though Warren Buffett is a big dividend investor himself, he never wanted to pay a dividend because he wanted his investors to see, how much money he's made for them. He never wanted to split the stock, never wanted to pay a dividend, wanted that share price to just continue to grow. And now with tech companies, they look and say, well, we don't want to pay a dividend because we want to keep those dollars within the company to reinvest and continue to grow. So this idea, this approach of having dividend investing being the sole approach for your retirement income and your retirement nest egg, that's gotten harder and harder to do. However, it still can be a great strategy, or at least part of your retirement nest egg. So what are some of the investment fallacies or falsehoods that you need to overcome, or at least be aware of, if you're wanting dividend investments to be part of your retirement income approach? The first falsehood is that stocks that pay a dividend offer an additional return above and beyond stocks that don't pay a dividend. That if you have 2 investments, 2 companies, and one pays a dividend and one doesn't, that the one that pays a dividend is giving an extra return. That's not officially true. I saw this article recently from the company Morningstar, great investment, sort of third-party investment analyzer and research company, and had a great analogy. This individual had a great analogy that I thought would really help demonstrate the point.
Dividend fallacy. What's going on there?
Okay, so the dividend fallacy, if you'll bear with me, so we're only a couple weeks past Halloween, so maybe you've got some Halloween candy floating around your house still. Yes. Okay, so let's say that you and I went trick-or-treating and we each have some of those full-size candy bars left. Those are the best. Yeah, so and let's say that my candy bar, full-size candy bar, same as yours, represents a share of one stock share for a dividend-paying company. You have the same candy bar, but yours is going to represent a non-dividend paying stock. Now, the dividend fallacy comes into play where this idea that I have my chocolate bar, and when I get my dividend, it's like in addition to my full-size chocolate bar, I'm getting those little mini chocolate bars. Bite size. Now the bite size. So now I've got my full size and my bite size. You've only got your full size, so I've got more chocolate than you, so I'm better off than you. And what investors don't realize is that stock prices do adjust for those dividends that are paid. So I might have a full-size bar and a bite size, but my full-size bar has shrunk just a little bit, and I have the same amount of chocolate as before. So you and I have the same amount of chocolate, but my fallacy is that I've got a little piece that you don't have. So I somehow have more.
So two companies, one pays a dividend and one doesn't necessarily mean that there's an extra return being provided from the company that pays out the dividend. Now, this gets super confusing because it's real companies, not chocolate bars, right? And prices are changing constantly, right? They're hopefully growing, they could be shrinking, and therefore it often gets overlooked that the company that's paying a dividend just saw their stock price go down slightly. But in truth, it's still the same amount of chocolate, and one's just paying a dividend, and that king size bar is just getting a little bit shorter and shrinking just a little bit, versus the one that's not paying the dividend, keeping those dollars in the company to hopefully have more growth and capital growth out there in the future. So that's one fallacy. The other falsehood is this notion of a dividend trap. We call it, actually, Kevin Korhorn, the founder of Korhorn Financial Group, when I was starting my career, called this a dividend rally, okay? When you've got two companies, they each pay a dividend. One's dividend yield is 2.5%, and the other dividend yield is, say, 6.5%. And you might look and just looking at the dividend, or if your sole focus is how much dividend can I get, let me get as much dividend as possible, you might look and say, well, then company B, the one that's paying the 6.5% dividend, is a much better investment than the one that's paying a 2.5% dividend. However, what is that dividend yield? What's the formula for that? That is the dividend that's being paid divided by the stock price. Well, both of those, by the way, can change, but the stock price changes all the time. And if a company had a 3% dividend per se, but the company stock started to crater, really started to crash and go down, then that dividend yield would look higher, because the amount of dividend that's being paid every quarter or whenever they pay it, divided by the stock price, well, as the stock price goes down, that ratio gets a lot higher. And so you might see a high dividend is actually and if that's how you're investing, these high dividend investments actually could just be underperforming companies or maybe vulnerable companies. So this idea of a dividend trap, if you're solely focused on dividend, and the higher the dividend, the better, that could lead you to invest in more risky companies. Because you might say, no, actually, I don't care, because if the price is low and the dividend stays, then I can get a higher yield and I'm good. Yeah, but if that price continues to go down, that dividend may be in jeopardy. And it's common that as a company is fledgling and trying to survive, that they may cut their dividend or drop their dividend, or maybe this is just a sign that this company is heading into a tough patch and actually could even be exploring bankruptcy or other big changes. Being mindful of the overall yield, but ensuring that you're investing in quality companies. So like I said, dividend investing can be a great strategy for your retirement income, okay? And the point is to still stay diversified. Be aware of these fallacies, right? But also, if you're going to be a dividend investor and have this be part of your overall retirement income strategy, make sure that you're just not solely focused on this, that it's well balanced, right? That you're taking the right approach, and ideally that you've got great diversification as well, so that if maybe you fall into a dividend trap, or a few companies that you own are struggling and have a rough outlook, that it doesn't derail your overall retirement picture. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.